Hello. It is October 3rd. It is Tuesday. Joe with the Firm Market Roundup. I've got my 2 cents. Let's see what the markets gave us. You guys know the drill. Let's jump into it. Let's break it down to news of the day. We did have some pretty interesting news today. Basically, an economic report that changed the direction of these markets, or I should say, made them worse. Technical analysis. Let's see if we broke any sort of levels. And as always, we'll go through some charts and some trades bouncing around the Maverick community.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the Apply button in the video description. Let's break down what happened today.
Moving into the market analysis, we actually rolled right over. We talked about this yesterday. Corey made mention of a nice bear rally pattern that was going on. The markets finished pretty much flat. The Qs actually hung in there pretty decent. But as always, we like the consistency when it comes to some of these patterns, these bear rally when it rolls over. Now, it did get a little bit of help. Let's jump into the daily news. Is strong news, bad news? Take a look at this JOLTS jobs report. It came in super hot, 9.6 million. Expected to be at 8.8, I believe. But that just shows that we have an absolute strong job market, which does create an argument for increasing interest rates as the economy can handle it, right? Now, we used to look at this as the glass half full. This is a soft landing. People can stay employed. Inflation comes down. It's all great. But when the markets are in a south trend or falling apart, all of a sudden this strength becomes, oh no, we might still be strong enough to raise interest rates. It's just funny how things are interpreted. Take a look at the intraday move here on the SPY. This is exactly when this report came out and the markets went south and stayed south pretty much all day. The diamonds in the SPY break support levels. We'll get to those charts in a minute, but the large tech is keeping the Qs afloat for now. And it is at a pretty good support level. It's one that we hit last Tuesday when I was doing this end of day. And we had that little bear rally and rolled over. And now we're actually pushing or threatening that. But big tech, the big names, Apple, Microsoft, Google, NVIDIA, some of the darlings out there, Amazon, they've been holding these up a little bit. They did all go pretty much south today, but they are kind of late to the party. They are still big enough to actually hold the Qs from really falling apart, although we did see some pretty good moves to the downside. We still have that government shutdown worry. We avoided it, but no ground gain towards a resolution. Keep in mind that means this is going to come back up and affect the markets and be just another piece of weight that we have to worry about, right? So let's move over to how we finished. Down across the board. This time the Qs did break. Yesterday they stayed positive. Everything else rolled over, but not today. The Qs were down almost 2%, 1.87. But as you'll see, if you guys browse through some of those larger tech charts, they don't look that bad. Russell still rolling over quite a bit, down 1.68%. That's a pretty horrible chart. Mid-caps are getting smushed. Oil up just 0.78, but still below $90 a barrel. It's just kind of hanging in there, and gold was flat. You'd expect gold to have a little bit more of a reaction. Take a look at the yields today. This is the 10-year and the 30-year. 30-year threatening 5. In fact, it was over 5 before it settled just around this 4.9 level. And the 10-year just above parked itself at 4.8. Now, when you get yields this high, it's an absolute flight to safety and worry that these markets are done. You could interpret it as, yes, we're going to hit a recession, all sorts of things. So, and understand, we're pretty sensitive right here. These markets are super, super sensitive and very reactionary at these levels. So let's jump into the markets themselves and break down these charts. This is the SPY, and as you can see, it's pretty easy to see that we are waiting for this rollover or this break, and we actually got it. This is that nice little move to the upside, a gap up and a move down. It could be blow-off tops, dark cloud cover. This is referred to it as an absolute reversal signal pattern to the downside. And yeah, it happened at a certain level that we can see back in here. But now we need to focus on the level that we're at, right about there. So the next one will be the 4,200 level, somewhere around here, which is basically where we sat at. and we'll see if we can't float through that. Based on the momentum that we carried for today, my bet is that we actually either gap down and start to come back up there, or come back off of a gap lower, I should say. Let me go ahead and just draw it. A gap lower here, and then have a candle that kind of comes back. Or we do get a gap up and maybe a little bit of a hang on for a day or two before we retest those lows. So anything can happen. Understand, folks, when we do get sell-offs like this, we do get bounces. So expect bounces. Do not misconstrue a bounce for a bottom or a multi-day rally or something that's going to bring your bulls back. It can mess with some of your bears, which is kind of a bummer, but we do need to stay on the bear side for sure. Let's take a look at the Qs here. Qs is in a little bit of a different story as it has yet to break. This is the bounce that it had, and it bounced before it broke its support levels. And look where it closed, right at it today, where the SPY and the diamonds broke support levels and bounced back up to the hit and use them as resistance. This is still a pretty ominous looking chart. If we continue to sell, these are not going to hold themselves up just because they are the outperformers, and they have been, boy, for all summer long, all year. Since spring, they've been leading the way. When there's a massive sell-off, everything will go. So these will be pretty slow to follow. So if you're looking for something to jump into a little bit later as we really start to push, we could look in this sector. I'm actually looking at some ETFs as well. So if you guys are looking at them, ETFs have been showing some pretty good bearish signs. So how do we fare? Well, I was going to say, hey, all the big tech hung in there, but not today. They didn't. You can see it's pretty much red all aboard. What did is utilities. Now, folks, I got excited because I said, hey, look, I gotta jump over to this utilities area here and look for some bull trades that I could share with the community today. And no, they're overextended, massive sell-off, and just gigantic green candles at a very, very bottom extended part of the base. Can't even get a real tradable pattern out of most of those down there. So where does that leave me? I'm just going to stay bearish. Below 20, below 50, slopes down. I'm -2. I wouldn't be surprised if we got a gap down and then rally all the way back up to close flat tomorrow, or we get a little bit of a gap up and then just give it up at the end of the day. It's kind of this insult to injury move that we saw, especially in light of correlating it with some of those numbers, with economic numbers that could be construed as good versus bad. So that's where I'm sitting. My monthly outlook is -2. I actually moved my weekly up to negative or down to -2 because I do like the confirmation of breaking lower support. So I do not have much at all when it comes to the bull side. I did find two charts, ExxonMobil and UNH Healthcare. I'll show you the healthcare. A couple things I have a problem with, but we'll get there. Nothing on the neutral side. I don't think anything rides this out, period. I think things that are sideways are just going to slip lower, so I don't like to play sideways trades unless I've got confidence that we're going to stay stagnant for maybe a week, 2 weeks. And I don't think we stay stagnant for that long. Potential bear side, I'm just adding to a pretty gigantic list that I've been adding to for months. Or weeks at least. So KBH is the new one, so I'm going to talk to that. IYC on the bottom there, that's consumer. It's a pretty good chart. XLP is another one that we like to trade here, but it's way extended. IYC hasn't dropped yet because it is, I believe, staples, or I don't know if it's discretionary, but anyways, it's hanging in there pretty good, but it might roll over. And then everything you've seen before. Disney looks good again. Amazon looks nice. Archer Daniels has a pretty good extension to the downside, and Caterpillar's good. But let's take a look at the ones that I do have, UNH and KBH. So here's KBH, and KBH is a beautiful chart, just kind of rolling down. I like how it's kind of stair-stepped itself down as it moves. It has a nice move back. Look at this crossover, comes back down to support, gaps through that. Here we come back to support here. Moving lower. It does have a little bit of a target back here to the side where I think it could hang up, but that's fine. I do think that it extends itself a little bit. It might rally, folks. We might catch a little bit of a rally here, so don't be afraid to do this a bit longer term, maybe a diagonal spread, vertical spread, something that can absorb maybe 2 weeks. The only thing you don't want to do is get into this for 2 or 3 days, have it bounce against you, and then have it expire at a loss, and then 2 or 3 days later it rolls over and it would have been a max gain. So give these a week and a half, 2 weeks. That's kind of what I'm shooting with most of my bear trades. Jumping straight over to UNH, I've got a decent looking base. Now what I don't like about this, 2 things. it's very counter trend versus what I'm seeing the overall markets do. So it's got me scratching my head. Something stinks here. I don't know why this thing is looking so good. And the other one I didn't really like for much was the price point on it. $500 a share is pretty high. So if you're going to do this, let's do it as kind of an outlier, meaning, look, this thing's outperforming for some sort of a reason. I mean, right now it looks like it's kind of pinning itself to about that $510 level for, I don't know, maybe we could do some reading on it. But let's do something where we're leveraging this out. I don't want to spend too much money on it, so if we do like a 510, 520 vertical spread, something like that. Throw it out there for about a week or so and see if this thing can't just pop up higher. But straight calls here might be just a little bit too expensive. And in my opinion, folks, probably a little bit too risky. But ExxonMobil, I didn't have that chart. Go ahead and check that out. There are a couple outliers that are looking like more of a bull pullback in this situation than they are a bear rally, bearish breakdown that we've seen that are above actually some of their moving averages. But they are, the majority of them are in utilities and energy. So in conclusion here, guys, market sentiment remains bearish. There's no way around it. It's just obvious. Major markets rolling over below new levels. Even the Qs are threatening a support that they bounced off last week. Moving treasury yields could be a sign of expectations of higher interest rates down the road. That's kind of where the money goes. If you're afraid of the markets, you pull out of it and you go to a flight of safety. You go into, hey, let's do something safe. Let's say the yields, interest rates are going to go higher. Let's see if we can't put them in longer-term CDs and safer investments, which actually kind of hurts the markets. But it is a sign of a slowing economy or a slowing market. So whether that's true or not, that's where the money's going, right? And it's actually increasing those yields. Job openings higher than expected, showing strength in the economy. Is it too strong? Before I'd interpret this as, hey, this is a nice soft landing. Interest rates will come down. We're still heavily employed. We're not going to have a recession. That's kind of changed, at least the market's reaction to it. Now, we do have ADP on Friday. That's going to be a similar report, a little bit different. We'll see if there's expansion or jobs being needed in the private sector as well. And then we'll just go from there, I guess. It really just depends on what the market's interpretation of some of these reports. They aren't that far off, and they aren't really anything to be that afraid about, right? But the markets, boy, they like selling into it. Earnings reports, just check potential earning trades. I went through a bunch. I didn't see anything that was we got enough to worry about. We also, like I say, we'll keep an eye on the government shutdown. There's all sorts of things to spook these markets. Stay bearishly exposed for now. If you don't like playing the bear side, just sit out. No reason to try to catch the bottom just yet because the bottom might not be in. All right, guys, thank you so much for joining me, and we'll talk to you next time. Bye, folks.